Okay, so today we're going to talk about something that I haven't really talked about in many years, and that is choosing a variable rate perhaps instead of a fixed rate. Since 2008, when the subprime mortgage boom collapsed, we haven't seen the Bank of Canada with rates more than 1.5% higher than we have today. That event triggered a $13 trillion reduction in US household net worth alone. The low bank rate that we have today is actually at the same low rate that it was after that event back in 2007, 8, and 9. The estimated cost of COVID-19 in the US alone is larger at $19 trillion. So COVID's a big thing. We keep talking about it, but it's a big thing. Now, looking back, it took until 2018, that's 10 full years, for the Bank of Canada rate to get to that high point, 1.5% higher than it is today. Now, if we're looking over the next 5 years and we want to compare the 5-year fixed rate today to getting a new variable rate today, it's very reasonable to expect that we're not going to see that variable rate increase by more than 1.5% between now and the end of 5 years from today. Okay, so at the end of October, the Bank of Canada, they made an announcement that they would stop buying bonds. That's called quantitative easing. And doing that is a big part of the reason why the fixed mortgage rates were as low as they have been over the last year. If you've been paying any attention, you know that fixed mortgage rates got to as low as under 1.5% back in February of this year, 2021. But now they're back above 2.5%, which is much more a normal range for interest rates. If we look back at discounted fixed interest rates in the 8 years or so before COVID-19 came onto the scene, we're going to see that rates were between 2.5% and 3% almost that entire time. There's a few moments where it did get a little bit higher, and there's a couple times that it dipped just under that 2.5% point, but that's really the normal range over the 8 years after the subprime mortgage issue of 2007, 8, and 9, and before COVID-19 came. Now, we are seeing high inflation. People are talking about that. It's in the media. Everybody seems to want to blame Trudeau because, in Alberta, that's what we do. But you know what? If we actually look at the data, if we look at what the Bank of Canada is saying about the inflation in September and more recently, it's very obvious that the reason for that inflation is because of supply chain problems. We're having a much harder time getting goods to market. And as a result, there's fewer goods available. But it's not because of a high demand. It's not because of high job rates. It's not because of so much extra money in the economy. It's really truly because we don't have a supply. So we are seeing pandemic-related supply shortages that are causing inflation. In the bank's forecast over the next couple of years, we're going to see inflation normalize closer to the 2% target that they want to see. We are going to still have COVID around in the world. It may not be a big deal here in Canada or even North America or even the developed world, but it is a global pandemic, and it is going to continue to have some impacts on things like the supply chain over the next several years. Now, the bank did announce in their October 2021 announcement that they hope to be able to start increasing their interest rates in kind of the middle 2 quarters of 2022. So, let's assume a few things. If we look back at the subprime mortgage collapse after rates bottomed out, they increased only 0.75%. And then they stayed steady for about 4 years, dropped a bit more, and then raised more in 2017 and 18, a full 10 years after that major event. So let's make a couple assumptions. We'll look at a worst case scenario, we'll look at a best case scenario, and probably reality will show up somewhere in between these two extremes. So let's assume that, say, 9 months from now, we start to see interest rate increases from the Bank of Canada. That's going to cause the variable rate mortgages to get more expensive than they are right now. Now, today we can get a variable rate mortgage from a good lender for about 1.15%. That's insanely low. Now, on the contrast, we're looking at about 2.5%, maybe even a bit higher for a 5-year fixed interest rate. So if we make an assumption that starting in about 9 months, we're going to see an interest rate increase over, say, a 12-month period of a full 1.5%. That's going from 1.15 all the way up to 2.65, which is actually higher than the fixed rate would be on day one. In fact, for almost 40 of the months, we would have an interest rate higher than the fixed rate. Even in that scenario, you're looking at saving on, say, a $400,000 home with a 5% down payment. You're looking at saving about $4,500 by taking the variable rate, in spite of it being at a higher rate for most of the 5 years because of those savings really early into the term. And I believe that that's the worst case scenario. Now, let's look at the other extreme. Let's say it's similar to what happened after the subprime mortgage collapse. And we see, again, starting in about 9 months, a 3.25% increases over a 3-month period, which would mimic what happened back in 2010 when rates came up after that event. If we do that starting in 9 months, we'll see the rate raise only up to 1.9%, which is, of course, significantly less than the 2.5% or so 5-year fixed rate. And you know what? In that scenario, we're looking at like $14,000 in savings of interest over the next 5 years. That's huge. Now, maybe you say, that's great. Let's save some money early on. But remember how interest rates in the 8 years previous to COVID-19 coming on the stage, we saw rates between 2.5% and 3%. That's more or less where we're at today. Well, if you want, you could also certainly take a look at doing a variable rate now. Variable rates come with the option of converting to a fixed any time in your 5-year term. So maybe wait till the springtime. We're in the fall, into the winter, and rates are higher. Perhaps in the springtime, we'll see rates still around this time, but you'll be able to save a lot on that variable in the meantime. So spring 2022 or maybe spring 2023, go ahead and lock in at that point, but you'll have the opportunity to save a lot of money between now and then and still come out ahead compared to choosing to lock in at that 2.5% or higher fixed rate today. I'd say, you know what, this makes sense. There's a lot of money being left on the table if you don't choose a variable rate today. If you really truly need that certainty of the fixed, go ahead. But there is a risk in both scenarios. There's a risk if you take the fixed that you're going to end up paying a lot more interest than you would have by choosing a variable rate. And of course, on the other side of that, if you take the variable rate, there is of course a risk that we're going to see rates increase so much that it is actually more by taking the variable rate, although I would argue that that's a very small risk and the savings are very much available to you. If you want to ask more questions, go ahead and book a time with me, reach out to my team, and we're certainly here to help you. Thanks so much.